In this episode, we are going to talk about the 15-minute time frame. This time frame is the easiest and the best time frame for intraday bias. So without wasting any time, let's get into it.
So first, let me explain clearly how we are going to use the 15-minute time frame and what its actual purpose is. The 15-minute is not something I use often for reversal trades. There are very few cases where I rely on it for that. Instead, I mainly use the 15-minute to frame continuation trades. That's where it really becomes powerful. So the whole idea starts from higher time frame context first. I want price to manipulate into a higher time frame point of interest, something like a 4-hour fair value gap, or at least a 1-hour fair value gap. That is the first condition. Price needs to tap into that higher time frame level, because that's where we expect reaction from institutions once price taps into that area. The next thing I want to see is that price actually respects that fair value gap, meaning it doesn't just blow straight through it, but shows some form of reaction. Now, once that reaction is there, this is where the 15-minute comes into play. I drop down to the 15-minute time frame and look for a fair value gap forming after that reaction.
And just to keep it flexible, you can also use a 5-minute fair value gap. Both work the same way, but the 15-minute just gives a slightly cleaner structure. So now we have two layers. A higher time frame, fair value gap where price reacted, and a lower time frame fair value gap forming after that reaction. The next step is patience. I wait for price to retrace back into that 15-minute fair value gap, and what I want to see is price respect that area, tap into it, and reject from it. Now this alone is not enough for entry. Once price reacts from that 15-minute gap, I go even lower in time frame and look for confirmation. This could be a change in state of delivery, an inversion fair value gap, or any lower time frame confirmation that shows momentum in the direction of the move, and once all of that aligns, higher time frame reaction, 15-minute fair value gap, lower time frame confirmation, that's where I take the trade. So the 15-minute here acts as a bridge between higher time frame context and lower time frame execution. It helps you refine continuation setups instead of randomly entering after a reaction. And now that you understand the logic behind it, let's move into a real chart example so you can see exactly how this plays out in live market conditions. Going into a real example, let's break this down step by step so you can clearly see how the 15-minute time frame fits into continuation trades. So starting from the higher time frame, what do we have at the pre-market open? We have a 4-hour fair value gap, and you can see that price respects it perfectly. Price taps into the consequent encroachment of that gap and bounces from it. So that's our first condition met. Price has manipulated into a higher time frame fair value gap and shown a reaction from it. Now once we have that, we move down to the 15-minute time frame, and on the 15-minute, what do we see? We see a small fair value gap forming. So now this becomes our next point of interest. But here's the important part. We don't rush into trades. You can see price taps into that 15-minute fair value gap before 9:30. But we ignore that because we want the real move after the market opens, so we stay patient. Then at 9:30, price comes back into that 15-minute fair value gap again. And this time it respects it. It taps into it and does not close below it. So now we have our second condition met. Price has retraced into a 15-minute fair value gap and respected it after the open. Now we move down to the 1-minute time frame for execution. What are we looking for here? We want confirmation, and as you can see, we get it. We get an inversion fair value gap, and at the same time, price sweeps the lows, which adds even more confluence. So now we have everything aligned, higher time frame reaction, 15-minute fair value gap respect, and lower time frame confirmation with a liquidity sweep. So this is where we take the trade entry. Comes at that inversion fair value gap, stop loss goes below the low, and target is the equal highs resting above. And as you can see, price moves cleanly and delivers straight into those highs. So this example shows you exactly how the 15-minute time frame acts as that middle layer. It connects the higher time frame point of interest with the lower time frame confirmation. And when you follow this process step by step, you're not guessing, you're building a structured continuation trade with multiple layers of confirmation. So that's how you use the 15-minute time frame for continuation trades the right way. It's not about taking random entries. It's about building a clear sequence, higher time frame reaction, 15-minute refinement, and lower time frame confirmation. Once you start following this process, you'll notice how much cleaner your trades become and how much easier it is to stay patient. The key is always the same. Let price come into your levels, wait for confirmation, and then execute with confidence. And when you stay consistent with this, you'll start to see how powerful this simple framework really is. If you found this helpful, make sure to like and subscribe, and I'll see you in the next one.